Tomorrow morning, your phone may show no warning. The market may open normally. You may go to work, get paid, and watch another $100 move automatically into your retirement account. You will not choose a stock, study a valuation, or press a buy button. Yet, part of that money could quietly be routed into one of the market's biggest and most expensive technology bets. The final buyer of the AI boom may not be a reckless trader chasing a headline. It may be your index fund, and you may never realize you bought. SpaceX priced its shares at $135 on the 11th of June in the largest initial public offering in American history. Public trading began the next day, with the first trade near $150. Excitement exploded, and for a moment the market seemed to confirm every ambitious promise. But as of the 31st of July, the stock is trading near $112, roughly 17% below the price paid by IPO investors. This is not proof that SpaceX or AI is doomed. It is a warning that even a great company can become a terrible purchase at the wrong price. Now that same test is moving across the entire AI economy. For years, the boom lived comfortably inside private funding rounds, strategic partnerships, rising share prices, and enormous valuations inferred from relatively small transactions. Belief did most of the work, but belief cannot build a data center, buy a transformer, secure enormous amounts of electricity, manufacture a chip, or pay interest on new debt. Eventually, someone has to provide real cash. That is the question behind this video. AI is useful, and it will almost certainly change the world. But how much money will the transformation require? Where will that money come from? And what happens when some of the world's largest pools of capital buy according to a rulebook rather than a judgment about price? So follow that $100. It enters an index fund because index funds are cheap, diversified, easy to understand, and still one of the best financial inventions ever created. Instead of guessing which company will win, ordinary investors can own a broad collection of businesses and let the economy work over time. That idea is not suddenly wrong, but an index fund does not ask whether a company is cheap or its forecast is too optimistic. It tracks a benchmark. The index provider decides which companies qualify when they enter and how much weight they receive. The fund then follows that result as closely as possible. That creates a strange difference between active and passive money. An active investor may decide a new stock is absurdly expensive and refuse to buy. If the company qualifies for a benchmark, a fund tracking that benchmark needs a position. A rising price automatically gives an existing holding more weight. It does not force the fund to buy simply because the price rose. But new contributions, index inclusion, changes in public float, and rebalancing can direct more money toward the stock at precisely the moment valuation risk is rising. This is not a conspiracy. The rules are public, traders anticipate changes, and the buying is rarely one giant order at one exact second. Not every index follows the same rules. Not every listing qualifies, and not every retirement account owns the same fund. But mechanical demand is real. By itself, it does not create a bubble. At sufficient scale, it can change who absorbs a huge new supply of shares. The reason it matters now is scale artificial intelligence. Looks like a software story when it appears on your screen. You type a question, wait a few seconds, and receive an answer. Behind that simple experience sits an industrial construction project of historic size, land, concrete, cooling equipment, fiber networks, backup generators, substations, transmission lines, long-term electricity contracts, advanced semiconductors, and buildings that can consume as much power as small cities. The latest company guidance suggests that Amazon, Alphabet, Meta, and Microsoft alone may spend roughly $735 to $760 billion in capital expenditures during 2026. That is about $750 billion from just 4 companies. Although their reporting definitions are not perfectly comparable, not every dollar is exclusively for AI. Amazon also builds logistics infrastructure. These companies invest in offices, networking, traditional cloud services, and other long-lived assets. But technical infrastructure and AI capacity account for an enormous share of the increase. This is not a one-time software budget. Advanced chips must be installed in complete systems. Capacity must be built before every customer is ready, and the spending continues after a facility opens. There are operating, maintenance, financing, and eventually replacement costs. Public giants can use cash from existing businesses, issue debt, lease equipment, slow buybacks, form joint ventures, or sell equity. Private AI labs have fewer mature cash engines, so they depend more heavily on investors, strategic partners, customer prepayments, and enormous computing agreements. Alphabet's financing package shows how easily a giant headline can be misread. It announced potential gross proceeds of up to $84.75 billion. Roughly $44.75 billion came from priced common and preferred offerings, plus a private placement. A separate $40 billion at the market facility remained unused as of the 30th of June and was intended primarily to cover taxes tied to employee equity awards, so calling the entire $84.75 billion fresh AI funding would overstate the case. Still, the package shows how a profitable company can turn public market confidence into financial flexibility while its AI investment accelerates. SpaceX initially priced a $75 billion base offering. After the underwriters exercised their option, the company said gross proceeds reached approximately $85.7 billion. Other private technology giants may eventually seek public capital, although their timing and final size remain uncertain. Add that potential supply to hundreds of billions in infrastructure spending, and the market is no longer being asked merely to admire AI. It is being asked to finance it. That distinction matters because market value and cash are not the same thing. I imagine a private company with 1 billion shares. An investor buys 10 million at $100 each. $1 billion changes hands, yet the deal implies a company value of $100 billion. The other $99 billion was never deposited in the company's bank account. It is an estimate based on the latest agreed price. That estimate may be reasonable, especially while few shares are for sale. But once a company goes public, its valuation faces continuous public market price discovery. Paper wealth is asked to become liquid wealth, and the difference can be violent. Where does the real money come from? Retirement contributions, money market funds, foreign investors, corporate cash, bank credit, new debt, reduced buybacks, or the sale of other assets. None is infinite. Every dollar directed toward a new AI security cannot be used elsewhere at the same time. As the request grows, the price of capital matters more than the beauty of the story. The AI ecosystem is difficult to analyze because the same companies can be investor, supplier, customer, and financing partner. A chipmaker can invest in an AI lab. The lab signs a huge computing agreement with a cloud provider. The cloud provider uses that demand to justify new data centers, which then buy chips from the original chipmaker. Every contract can be real, and every participant may genuinely benefit. But investors still need to ask one uncomfortable question: how much of the demand is ultimately being paid for by independent customers, and how much is being supported by financing inside the same ecosystem? Strategic investment, cloud credits, reservations, and long-term commitments are not automatically fraudulent. New industries often need coordination before supply and demand grow together. Early commitments can solve shortages and accelerate a technology that later becomes highly profitable. The risk begins when internal commitments are mistaken for permanent external demand. If an AI laboratory can purchase more computing only because it raises another round of capital, and the valuation of that laboratory rises partly because it signed a larger computing agreement, the reported growth may be genuine while still depending on the next financing event. The engine works, but it needs fresh fuel. That is why revenue alone is not enough. Watch customer concentration, receivables, financing milestones, and whether outside companies pay full prices for AI services. Most importantly, watch free cash flow. Cash flow is much harder to flatter than a growth narrative. And even when the revenue is real, another question remains: how much profit is the infrastructure truly producing? This is where depreciation enters the story. When a company spends billions on servers and chips, it does not normally record the entire purchase as an expense in the first year. The asset is expected to help generate revenue for several years, so accounting spreads the cost across its estimated useful life. That is normal and necessary, but the chosen life changes the appearance of profit. Suppose a server costs $6 million. Over 3 years, the annual expense is roughly $2 million. Over 6 years, it is roughly $1 million. If the equipment was purchased with cash, the same amount left the company upfront in both cases, only the timing of the accounting expense changed. Michael Burry, the investor famous for anticipating the housing collapse, has argued that parts of the technology industry may be using useful life assumptions that are too generous for rapidly advancing AI equipment. His estimate suggested that depreciation expense across the industry could be understated by roughly $176 billion between 2026 and 2028, with a potentially significant effect on reported profits at companies such as Oracle and Meta. That is an argument, not a proven verdict. Burry has made extraordinary calls, and he has also been wrong. A chip does not become worthless when a newer model arrives. Older equipment can run inference and less demanding workloads, software can extend useful life, and companies use hardware differently. A lawful accounting estimate is not evidence that anyone is cooking the books. Still, physical life and competitive life are not identical. A server may keep running for 6 years while becoming economically inferior after 3. If customers demand newer models or power efficiency improves sharply, the true return can deteriorate faster than the accounting schedule suggests. So compare capital expenditure with operating cash flow. Check free cash flow, depreciation policies, impairments, utilization, and replacement plans. A company can report growing profit while consuming more cash each year. That is not proof of disaster, but it means the future is still being asked to justify the present. Now return to the private shareholders. In October 2025, more than 600 current and former OpenAI employees reportedly sold around $6.6 billion of shares in a transaction that valued the company at $500 billion at that time. This was a secondary sale. The money largely went to shareholders, not into OpenAI. Employees may sell to pay taxes, buy a home, or diversify years of illiquid compensation. It is not proof that insiders are fleeing. It matters only in combination with scale, valuation, cash burn, and growing speculation that the company may eventually seek public capital. It is one sign that more private paper wealth wants real liquidity, not a verdict on AI's future, and that brings the $100 back into view. NASDAQ introduced a fast entry mechanism for exceptionally large listings. A company must rank among the index's top 40 candidates and meet the remaining rules. A qualifying stock can typically enter the NASDAQ -100 after about 15 trading days, with a cap limiting the weight of low-float securities. SpaceX joined on the 7th of July, less than 4 weeks after trading began. Products tracking that specific benchmark then had to reflect its inclusion. Not every index fund in America. FTSE Russell can add a qualifying mega IPO to the Russell Top 500 after the 5th trading day. It retained its 5% standards while allowing conditional eligibility when lockups are expected to lift within 12 months. Crucially, locked shares are not counted in investable market capitalization at entries, and Dow Jones indices made a different decision. It retained the 12-month seasoning requirement for IPOs entering the S&P 500, along with financial viability and investable weight rules. An S&P 500 fund is therefore not in the same position as a NASDAQ -100 or Russell-based fund saying all index investors must buy every giant IPO would be false. The real concern is that some benchmarks can admit an exceptionally large company before the public market has tested its price for long. Tracking funds must reflect the new constituent. Other traders may buy in advance, hoping to sell into expected demand, so part of the mechanical buying can already be priced in before inclusion. That does not make index funds stupid. It means they are doing exactly what they promised. The misunderstanding belongs to investors who confuse rule, based with automatically cheap or diversified with immune from valuation risk. SpaceX is a warning, not a verdict. Its shares were offered at $135, first traded near $150, and later fell below the offering price. Fast index entry did not necessarily cause the lost valuation. Public float, business risk, market conditions, and future share supply all matter. But a celebrated debut quickly lost the assumption that success was guaranteed. At this point, the bearish story can sound overwhelming. Huge spending, connected financing, uncertain depreciation, insider liquidity, fast index entry, and a record IPO below its issue price. It would be easy to call AI an empty bubble. That would ignore real demand. The cloud businesses at the center of the boom are growing, although the figures do not isolate AI revenue or prove that every dollar of AI spending will earn an adequate return. AWS sales recently grew roughly 37%, and Amazon said its AWS AI business had passed a $25 billion annual run rate. Microsoft put its AI business above a $37 billion annual revenue run rate, up 123%. Oracle reported 77% growth in cloud infrastructure revenue for its latest fiscal year. OpenAI says annual recurring revenue passed $20 billion in 2025. Run rates are not audited standalone annual revenue, but companies are paying real money for cloud capacity, models, software, and automation. The infrastructure can create value beyond today's applications. Data centers serve multiple customers, older chips can be reassigned, and falling computing costs can unlock uses that are uneconomic today. The biggest builders also own global distribution, customer relationships, cash-generating businesses, and technical stacks that smaller rivals cannot easily reproduce. The bull case is not foolish. The danger is assuming that a correct technological forecast guarantees a good return. Commercial aviation transformed business, tourism, and migration. Yet airlines repeatedly struggled with high capital costs, competition, fuel prices, bankruptcies, and weak shareholder returns. Society can receive enormous value from a technology while its financiers fight over a much smaller pool of profit. I can succeed in the same complicated way. Applications may become essential while competition pushes prices down. Chip demand may stay high while rapid replacement cycles weaken returns. A few platforms may thrive while dozens of followers disappear. The technology, the company, and the stock are three different things. From here, there are three broad paths. First, the spending proves rational independent customer. Revenue accelerates, unit costs fall, utilization rises, and free cash flow catches up with capital expenditure. Today's valuations are gradually justified by tomorrow's profits. Second, the technology succeeds, but the stocks cool down. Revenue grows too slowly for current expectations, and prices move sideways or decline while earnings catch up. The bubble loses air without one cinematic crash. Third, outside financing tightens. Projects are delayed, commitments shrink, utilization falls, and companies record impairments. Falling prices automatically shrink a stock's index weight. They do not, by themselves, force a market cap-weighted fund to sell. Additional selling can appear if the company leaves an index, its eligible float changes, or investors redeem the fund. Under those conditions, a financing problem can become a broader market problem. Nobody knows which path will arrive or when. One weak quarter cannot prove a bubble, and one strong quarter cannot guarantee safety. Decide in advance what evidence would change your mind. That brings us back to tomorrow morning and the next $100 entering your account. The automatic investment is not the enemy. You do not need to abandon index funds. Guess the top or short the most powerful technology companies on Earth. This is not personal financial advice, but every investor can answer a few basic questions. Open the fund you own and inspect its 10 largest positions. How much exposure comes from companies whose valuations depend heavily on AI spending? Then check the benchmark and how it handles new listings. The S&P 500, NASDAQ -100, Russell indexes, and global indexes are not interchangeable. Watch the businesses beneath the ticker symbols. Is free cash flow improving after capital expenditure? Is demand coming from independent customers? Are unit costs falling? Or is management simply announcing a larger construction budget each quarter? If you want concentrated AI exposure, make it an intentional decision rather than an accidental consequence of a fund name you never examined. If you want broad diversification, confirm the portfolio is still as broad as you believe. Rebalancing, patience, and low costs are not exciting. But excitement rarely protects capital. The technology can win, and the shareholder can still lose. AI only needs to deliver less than the price already promises. Index funds do not need to be broken for investors to discover that diversification can still contain expensive assets. If an AI bubble eventually breaks, the most important question will not be who shouted the word bubble first. It will be who understood why their money was there, what assumptions it was funding, and what evidence would make them change course. That $100 can keep investing, but from now on, it should no longer be voting with your eyes closed.